So what we're basically seeing now is the Empire Strikes Back, right? And so if anyone has seen the Star Wars trilogy, the original one, you had the initial movie, and then you had a response to that, right? So if you look back in the past couple of years, we had this gigantic inflationary response. We had all these like speculations and things like that. And now we have a variety of central banks around the world, mainly the Federal Reserve, trying to fight back and regain some degree of like a stability with their currencies. And the problem is that they're about 2 decades too late, right? So, a lot of these seeds were set in like the Greenspan era, the 90s, the 2000s. But nonetheless, with super high debt to GDP ratios, they're now trying to fight back and regain some degree of currency stability. And that's causing massive volatility in financial markets and specifically in sovereign debt markets, because that's ultimately the limiting factor when you get to the end of the road in terms of kicking the can down the road. So yeah, so we've had 4 decades of structurally declining interest rates, little cyclical rises, but mainly structurally downward. And that allowed for all this debt accumulation and, asset price, appreciation as well. Because, if you are measuring a stock valuation based on a 7% treasury yield, you might want a 11% return, for example. Like maybe you want a 4% equity return premium over that treasury. But if treasuries are 0% or 1%, you might want a 5% equity return because you still want a 4% equity return over that treasury. And so you're willing to pay a higher valuation due to TINA. There is no alternative, right? And so you had 4 decades of declining interest rates and higher real estate and equity valuations. And the problem is when you run into the zero bound or slightly below it, and then you also run into an energy crisis. So, we go through these historical cycles of underinvesting in commodities and especially energy. And then you get inflationary pressures from that supply situation, which have been exacerbated this cycle by ESG and other things like that. But nonetheless, you have that combination of super high debt, zero or sub-zero interest rates, and then, real world constraints. Now you run into a problem. Now you have interest rates going sideways to up, and this year mostly up, and that puts a lot of pressure on the whole system, right? So all those like dollars, like you had dollars in your brokerage account, based on your stock valuations, you had dollars in your bank account, you had dollars in your treasury bonds, and all of those were supposed to represent claims for real world resources, right? But when the cost of those resources go up, and then the valuations of those financialized, second, third, fourth layer derivative assets start to go down. It turns out that the vast majority of those claims are not really worth, the real world resources that they thought they were, especially if a significant portion of the population tries to call them in at once. And that's essentially what we're going through. And that's what we go through in every kind of generational disinflationary to inflationary cycle historically. So indirectly, yeah, I mean, I think we can separate the problem into the proximate cause, meaning like the immediate cause, and like the core underlying cause. And so the core underlying cause is weak money. If you have weak money, artificially low interest rates, currency that keeps devaluing, there's a very strong incentive to, borrow money and buy hard assets, right? And so that's the structure we've been in for 40 years. Now, the proximate cause is when some of those things start to blow up. And so we had a bunch of proximate causes back in the 2008 crisis. And now we're getting another wave of those. And for example, UK pensions, which are the most, kind of newsworthy, they had a variety of, programs in place where they would use their UK government bonds as collateral to own derivatives that allowed for a smoother payout period. And it's less so about speculation in the sense that they were trying to juice returns like a degenerate trader, and more so about trying to smooth their returns, knowing that they, as a pension, have a very like well telegraphed and known liability payout ratio, month after month, year after year. And so they're essentially, paying for volatility reduction. and they're basing this on models that, government bonds may fall, but they can only fall by so much. And so when you have a multi-decade, century bad sell-off in government bonds, that breaks all the models. And then the problem is that every UK government pension is using the same system. And these are the biggest balance sheets in the country. And so if all the big balance sheets are selling, government bonds at the same time, then the problem is that cascades, because if pension one sells their bonds to meet their collateral calls, then the prices get worse for pensions 2, 3, and 4. And they have to sell theirs as well, because that just broke that, even if they were a little bit less leveraged, they now, because the prices got worse, they have to sell theirs now. And then you have, pensions 5, 6, 7, and 8, 9, 10, they have to sell theirs now, even if they were even less leveraged, because the prices got even worse, right? So the problem is that all the pensions use roughly the same system, with mildly different levels of risk. And it's less about, that these are just crazy casino operators, and more about, these pseudo sophisticated ways of trying to manage their liability outputs in a system that, going back to that's the proximate cause. Now going back to the core cause, the fact that money is weak, interest rates are artificially low, and that's what allows for all of these constructs to exist to begin with, and all of these perverse incentives. So for example, if you are in a situation where you don't see a clear path where your assets are going to meet your liabilities, one of the options is to try to take more risk to have those assets meet the liabilities. And in the small percent chance that you're right, that could work out. But of course, any sort of wise person would hear that and say, unless you're Stanley Druckenmiller, you're probably going to mess it up, and you're probably going to be even worse behind on meeting your liabilities. And so that's, again, it's just another perverse incentive of the current system of weak money. And, we can tie this, I agree with your point about fragility. We can tie this back to, for a regular person running their own finances or running a small business. We can imagine a totally unleveraged scenario, right? So you have no debt other than maybe a small mortgage, right? That, with a very low kind of a loan to value ratio, but, virtually no leverage in your business. You have cash flows, you have expenses, and your expenses are below your revenues by a considerable amount. And so you have a high savings rate. Now, if you encounter a recession and you have a bad year, it doesn't feel great, but you don't go insolvent because you don't owe anyone anything. And you have a huge buffer between your necessary expenses and your income and cash flows, right? So you go through ebbs and flows of the economy, and you're very resilient, even though, of course, some years are more enjoyable than others. Now, to contrast with that, if you have a extremely high leverage system, which can only exist in an environment of artificiality, right? If interest rates are artificially low, if there's an artificial incentive to borrow, if money is weak compared to real assets and therefore incentivizes borrowing that weak money to buy those real assets, it builds up all this leverage in the system. And then when you have a contraction, you're in a very different environment. I mean, if you owe a lot of money and your cash flows contract, you could go insolvent a lot faster compared to that prior example of someone who's totally unlevered and is just riding the wave of the economy. And so we're in that second system globally, where we have super high debt to GDP ratios, debt to both on the sovereign level and the private level. And that's why we're in aggregate in such a fragile state at the current time. So you can trace it back to the individual private participants that made bad decisions, but then at the deeper level, you can tie it into the central bank and the policymaker incentives, where one, they always bail out the system when it gets bad enough, and two, they artificially lower interest rates in order to purposely incentivize higher debt accumulation.